Imagine finding an official IRS envelope in your mailbox. You've always paid your taxes, so you aren't worried, until you see a $10,000 penalty notice. The reason? A simple money transfer you made months ago. You didn't underreport income or miss a payment, yet you're being fined for moving your own money in a way the government didn't like. Hey everyone, I'm Mr. Greenvestor. Today we're talking about a digital trap catching honest retirees and investors off guard. Most people think the IRS only targets billionaires or criminals, but a logical bank transfer can now trigger a massive penalty. You've spent decades building a nest egg to support your family. You deserve to enjoy that security without looking over your shoulder. However, one decision at the teller window can flag your account for structuring. We're talking about an automated $10,000 fine, triggered the moment a computer identifies a pattern in your deposits. Over the next 14 minutes, I'll show you which transfers trigger these red flags and exactly how to move your money safely. If you don't understand how these automated systems work in 2026, you're walking through a financial minefield blindfolded. Let's get you the map to navigate it. To understand how to protect yourself, we have to look at the specific rule that catches most honest people, which is the Currency Transaction Report, or CTR. This isn't a new law, but the way the government enforces it has changed completely. By law, anytime you deposit or withdraw more than $10,000 in cash, your bank has to file a report with the federal government. For most of us, that sounds like a major headache that we would rather avoid. You might think you don't want the government snooping in your business, or perhaps you just want to save the teller the extra paperwork. Because of that, you decide to be smart and split the transaction up. Instead of depositing $11,000 at once, you deposit $9,000 today and $2,000 tomorrow. In your mind, you are just being a private person who likes to keep things simple. In the eyes of the law, you just committed a federal crime called structuring. The reality is that the IRS doesn't actually care if the money is legal or where it came from. You could have earned that money from a pension, a car sale, or a legal gift, but none of that matters to them. What they care about is that you intentionally tried to bypass the reporting limit. It's a very strange part of the law where your intent matters more than the actual action you took. Think of it like a speed trap on a highway where the limit is 65 miles per hour. You see the police officer ahead, so you naturally slow down to 64 to stay safe. In this scenario, the officer pulls you over and gives you a massive ticket, not for speeding, but because he thinks you were trying to hide the fact that you wanted to speed. It sounds unfair because it is, but under the legal language of 31 U.S.C. Section 5324, the government only needs to prove you had the intent to evade a report to fine you or even seize your funds. This is why the paperwork of a CTR is actually your best friend rather than something to fear. When a bank files a report, it creates a transparent record that protects you from suspicion. It says that here is the money, here is where it came from, and everything is out in the open. Transparency is your shield in this situation. When you try to avoid the report, you look like you have a secret. And in the world of modern banking, having a secret is the fastest way to get your account frozen. The most dangerous part of this trap is that people often do it because they are trying to be responsible. They've heard horror stories about audits, so they try to stay under the radar to avoid trouble. But the radar has changed. In the past, a human being had to notice your banking patterns and make a judgment call. Today, it's all handled by algorithms that act like digital bloodhounds without any common sense. They don't know you've been a loyal customer for 30 years, and they don't care about your reputation. They only see 2 deposits that add up to $11,000 and a missing report, which is all it takes to trigger an investigation that can last months and cost you a fortune in legal fees. The bottom line is that the $10,000 threshold isn't a ceiling you should avoid hitting. It's just a marker. If you have the money and it's legitimate, what tiene? Let them file the report so you can move on with your day. It takes 2 minutes of your time, and it keeps the digital bloodhounds at bay. Now that you know the core rule and why trying to be safe is actually the most dangerous thing you can do, let's look at the 4 everyday scenarios where this trap actually snaps shut on unsuspecting retirees. Now that you understand the basic rule, you might think it is easy to avoid. You just don't break up big deposits, right? Well, the thing is, many people trigger these red flags during totally normal life events. They aren't trying to be sneaky or break the law. They are just trying to manage their money the best way they know how. Let's look at 4 common situations where this trap usually snaps shut on honest retirees. The first one is the gift loop. Imagine giving your grandson $15,000 in cash for a home down payment. To avoid causing trouble with bank questions, you give him $3,000 a week until it's all moved. You think you're being helpful by staying under the radar, but you've actually handed him a structuring violation. The bank's software flags those repeated deposits immediately. Instead of a gift, your grandson gets a frozen account and a stressful IRS letter. Scenario 2 happens a lot with the private sale. Let's say you finally sell that classic car or the RV you've had in the driveway for years, and the buyer pays you $12,000 in cash. You don't feel comfortable walking into the bank with that much money at once, or maybe you just don't have time to go today. So you deposit $5,000 on Tuesday, and then another $7,000 on Friday. To you, this is just a matter of convenience and safety. To the IRS, it looks like a textbook case of avoiding a currency report. Even though the sale was perfectly legal, the pattern of splitting that cash into 2 smaller chunks is exactly what the automated systems are programmed to find. Then we have the contractor payment. This one is a bit different because it involves taking money out of your account. Suppose you are doing a big home renovation, and the contractor asks for cash to pay his crew. So you go to the bank and withdraw $9,000. A few days later, you realize you need more supplies, so you go back and pull out another $3,000. This doesn't just trigger a standard report. It often triggers something called a suspicious activity report, or an SAR. Your bank teller might not even say anything to you at the window, but they are required to file this if they think you are trying to bypass the rules. Once that report is filed, it goes straight to a federal database, where it stays forever. The 4th scenario is the internal shuffle, moving money between your own accounts at different banks for better interest rates. If you move $9,000 repeatedly to stay safe, it looks like layering, a technique criminals use to hide money sources. Even though you're just moving money from your left pocket to your right, the digital bloodhound sees the pattern and flags it. The bottom line is that these systems are now fully automated and very efficient. They cross-reference your bank activity with your tax returns in real time to look for discrepancies. If the numbers don't match or the patterns look off, the computer doesn't care about your intentions or your history. It just flags the account and starts the process. Protecting yourself is actually a matter of simple documentation and being prepared. The first step is to stop fearing that $10,000 number. Most people treat it like a forbidden zone, but a reported transaction is a transparent one. In the eyes of the IRS, transparency is your best shield. When you hide, you look guilty to an algorithm. When you report, you look organized. Start a life ledger. This is just a physical folder or a digital file where you keep your records. Keep every piece of evidence for your big money moves so you're never caught off guard. If you sell a car, put the bill of sale in there. If you withdraw cash for a home project, keep the receipt from the contractor. This folder turns a scary IRS letter into a 5-minute fix. Instead of panicking, you just pull out the paper that explains the math and proves you did nothing wrong. If you are gifting money to your family, you need a gift letter. This is not a complex legal document that requires a lawyer. It is just a simple note signed by the person getting the money. It should state clearly that the funds are a gift, not a loan, and not a payment for any work performed. This one piece of paper can stop a structuring investigation before it even starts. It proves there was a clear, legal reason for the transfer and removes all the mystery. Before you make a move over $10,000, go talk to your bank manager. Don't just deal with the teller at the window who is busy with a long line of customers. Sit down in an office and explain what you are doing so they understand the context. Tell them you are selling your RV and you want to make sure the deposit is handled correctly. When the bank knows the story behind the money, they are much less likely to file a suspicious activity report. Your wealth is only as secure as your understanding of the rules governing it. The reality is that the IRS systems aren't going to get simpler or more forgiving as time goes on, but your plan to deal with them can. You don't need to be a tax attorney to protect your retirement. You just need to be more organized than the algorithm. This isn't about hiding your assets. It's about being so transparent that there's nothing for a computer to flag. I want to give you a simple 7-day challenge to bulletproof your accounts. This week, take 30 minutes to look back at your bank statements from the last 90 days. Specifically, look for any transfers or deposits over $2,000 that might stand out. We use the $2,000 mark because that's often where the automated systems start paying attention to patterns, even if it's well below the $10,000 reporting limit. For every one of those moves, I want you to make sure you have a physical receipt, a bill of sale, or a simple note explaining exactly what that money was for. If you sold something on Facebook Marketplace, print the account. On Facebook Marketplace, print the listing and the messages. If you moved money to a high-yield savings account at a different bank, print the transfer confirmation from both sides. If you received a cash gift from a family member, have them send you a quick email confirming it was a gift and print that out. Put all of these documents in your life ledger immediately. This creates a clear, undeniable timeline that any auditor can understand in seconds. The goal is simple. Stop trying to stay under the radar and start owning it. When you have a paper trail, you aren't a target. You're a prepared investor. This isn't about being afraid of the government. It's about being so organized that their automated systems have no reason to look twice at you. Don't let a simple lack of paperwork put your hard-earned life savings at risk. Look, your life ledger is the ultimate defense for your retirement. It's the best insurance policy you'll ever have, and it costs you nothing but a few minutes a month. If this breakdown gave you some peace of mind, hit that like button and subscribe to the channel right now. It helps us get this vital information to more people who worked hard for their money. And do me a favor, share this with another retiree or someone getting close. You could save them from a massive unnecessary headache. Start that ledger today. To keep your momentum going and find more ways to protect your wealth, click the next video on your screen right now to learn more about retirement planning. See you in the next video. Cheers.